Hey everyone, this is Kirk here again at OptionAlpha.com, where we show you guys how to make smarter trades. And today we're going to go over all of the trades that we made for Tuesday, September 9th. So it was actually a pretty big day in the market. We had a pretty even balance of opening trades, closing trades that we got out of, and then also some adjustment trades to SPY and EWZ. But what I want to start off with tonight is just taking a look at one of the things I think is really interesting about Apple and then some other stocks. I think it was actually a really interesting day in the market. But Apple obviously had their huge announcement today for iPhone 6, yada, 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 whatever the case is. But isn't it amazing that a lot of people, you start reading the headlines on this thing and even going through stock tweets and Twitter, and everybody thought that Apple was going to be up around 105, 106, 107 today after the announcement. And it's just really funny because now you can see the stock chart today that Apple actually closed down on the day by like 35 cents or something. So not a huge move lower, but look what did go lower, and that's implied volatility. So IV for Apple the other day was up around the 67 to 70th percentile. And as soon as this announcement went out, IV dropped like a rock. And the stock was actually really volatile today. So we had huge wicks on either end. So the stock at one point was up to 103. At one point during the day, it was all the way down to 96 and then kind of settled right around 98 or so. But just really goes to show you just how quickly implied volatility can contract after these earnings announcements. Not really earnings announcement, but any company news. And also that nobody has a clue where the stock is going to be going. So everyone really predicted, everyone was super bullish on Apple, and it very well may, continue to trade higher after this. But everybody on stock tweets and Twitter was thinking that Apple was going to go higher, and they all just got their faces just absolutely smashed in a pie today and just had no clue where the stock was going to go. So I think it's really interesting and obviously a huge testament to just not knowing what you're going to be doing and being okay with that, right? Making high probability trades, not trying to guess where the market's going to go. All right, so as far as new opening trades today, let's go over those first, and then we'll kind of work our way down the list. The first new trade that we went into is YHOO. So we went extra deep into YHOO. So we already have a position in YHOO for September that's working out pretty good. Now we're adding a position for October because we just can't go away from the fact that it had 100% implied volatility at the time we made this trade. And you guys are going to love just how quickly we made money on this trade, even today, because of the drop from 100% implied volatility down to where it's at right now. So with YHOO, what we did is we want to take advantage of that by purely selling naked options. So we did a very wide strangle in YHOO. We did the October 50 calls and the 35 puts. And incredibly, we took in a massive credit of about 117 cents on each of those. So you can see that we scaled it up a little bit on that side because it was just such a good trade. We were trading the 50 strikes on the top side, 35 strikes on the bottom side. Very good trade in YHOO. So today, at the end of the day, though, YHOO actually closed down on the day. It was down about 2.5%, and you can see kind of a huge almost reversing pattern that might happen on YHOO. And IV dropped from 100 down to 85. So that's actually a pretty significant drop, about 15 points there in IV drop. And because of that IV drop, let me just go to the trade tab here. You can see that today, for just our trade that we have in YHOO for October, this strangle down below, not all the other ones for September that are thrown in there, but just this strangle for October, we made just today about $93 alone on that IV drop. So just in a matter of a couple hours, from implied volatility going from a level of high to a level of low, you can very quickly make money with these strangles, which again just really proves the point. I'm not here to showboat about making $93. It really is meaningless to me. It really proves the point that you should be trading the right strategy in the right market. Had we bought options when YHOO's implied volatility was high and YHOO was going crazy, there's no way we would have made money long-term buying options like this. It's just not in the cards because the stock can basically go nowhere and implied volatility drops and you lose money. So moreover than just showing you guys we made $93 right now, kind of paper money, we haven't closed out the trade, it really proves the point that you have to trade the right strategies in the right markets, okay? And learning how to do that is obviously critical to what we're doing here with you guys at Option Alpha. So as far as the strikes are concerned, I want to show you where we placed our strikes. We obviously did give the market a little bit more room on the top side because when we entered this trade, YHOO was up around 42, 43, somewhere in that range. So we want to give ourselves a little bit of evenness on each side. But what we ended up here with today is a call side trade at 50 that has about a 90% chance of success. So you can see the probability of Yahoo getting 250 and above and closing above that level by expiration is about 90% chance it doesn't get to that level. And then down on the bottom side, we've got about an 83% chance of success that Yahoo doesn't get down to the 35% level by expiration. So very, very high probability trade. We tried to make it fairly even on both sides. We were at about 85% on either end when we actually entered this trade. And since Yahoo actually closed lower on the day and had kind of a sell-off at the end of the day, that kind of shifted the probabilities a little bit. But that gives you an idea of where we're placing these strangles. Very wide, taking in a very good credit though. Okay, so the next trade that we went into, this one's a little bit tricky, and I actually sent out a couple comments on some social media sites on Facebook and Twitter and Google Plus and all that, just trying to find out what other traders are out there are doing with some of these currency ETFs, because the currency market is going crazy right now, and it's just in huge swings. We've got the Great British Pound and the Euro that's just tanking, and then we've got the dollar, which has just been on a tear, and I can't even remember the last time the dollar was on a tear like this. So I want to play it some way, but I had one little kind of confusing part that was really getting me hung up, and that was just how illiquid the markets were when we actually made the trade. I mean, there just didn't seem like there was a lot of liquidity in the markets. So we still wanted to play it. We only did one contract. It's still a debit spread in FXB, which is a currency ETF for the Great British Pound, which has just been I guess minor words, pounded recently and really crushed. And we wanted to play that higher. So what we did in FXB is do the October 157, 159 debit call spread. Paid a little over mid price at 111, but just want to get into the trade to get something going. I think it's just one of those things that you got to have money invested in something like this, because when it's just crushed down as low as it is, and here's a look at where the FXB is. I mean, when it's just crushed as low as it is, it's just really hard to go away from just how much of an opportunity there is for just some sort of bounce back, right? Not to say that there's not some underlying fundamentals that are changing, but at some point between now and expiration, all we need a bounce back above 158 or so. So you can see that we're already in the money here because our break-even's around 158. So as long as this thing trades just a little bit higher than 158, we'll continue to make money on this trade. So I think a lot of the actual volume today, which was kind of ironic, was a lot of Option Alpha members. So if I go here, we're up about $6 on the trade. But today there was a lot of volume, and right after we made this trade, a lot of volume started to take place in the 157 to 160 range. So that seems like it was you guys getting a lot of these trades in. I know a lot of people got into this trade. So I really like this trade, FXB. It does have very high implied volatility, which is great, but you really can't sell options too far out of the money. And with a stock this volatile in currency that, we just don't know what's going to go on, I didn't want to buy options in this case, or sell an option spread in this case, because you really couldn't get that far away to get a lot of premium. So you could get down maybe $1 or $2. And so even though it had a high implied volatility, you really couldn't get that far away. So we're making a pure directional trade here on this one. Our break-even's very favorable. All we need FXB to move just a little bit higher between now and expiration, and we'll be out of this trade. All right, so the other closing trade that we had today, or the only closing trade we had, is in Home Depot. So Home Depot finally made that nice move lower that we were expecting. We sold back to the market our 92.5, 90 put spread, and sold that back for a 160 credit. Very simple trade. We're making a very directional trade in Home Depot. Made about $40 on each of those, so a nice little $80 profit in Home Depot. We'll take a look at the chart here and just look at where it is, and obviously this is kind of the result of a huge run-up. So we actually bought this spread very close to the top, so anticipating this move over. And again, what we're doing with FXB is no different than what we did with Home Depot. It's just anticipating that at some point we're going to have some sort of market or mean reversion lower, or to the mean, kind of normalization. It can't continue up at this pace forever, and that's what we had. So we had to move lower. That's what we were looking for. Take what the market gives you. Use this opportunity to get out of the trade and bank a profit. Okay, so two of the adjustment trades that we made today. The first one I want to go over is actually SPY. This one is really interesting, and when I actually saw the alert, I actually said, this is kind of incredible that we were able to roll this from September to October for a credit, which is actually pretty amazing. But if you think about it, because implied volatility has gone up just with the market moving down today, actually the front month options, ironically enough, or the September options, were trading at a little bit of a premium to the October options. So what we did here with SPY is we rolled our 200 199 put spread, the same exact position from September, and rolled it out to October. So we closed out of the September and rolled it to October by closing it out and paying that debit, and then rolling it to October, closing it out and getting a credit, using that credit to roll to October and pay for the 200 199 put spread in October. We actually got paid to take more time and more opportunity to make this trade. So it's pretty incredible. You don't really see that a lot. You know that if you're obviously a member here at Option Alpha, you go through the video tutorials that we have on rolling options. You know that one of the key things with rolling options is to try to pay a very small debit, like 3 cents or 4 cents or sometimes 5 cents to roll it out. In this case, we actually got paid money in our pocket to keep the trade on for another month and have another opportunity to make some money. So really, really great roll in SPY. The whole idea here with SPY is that we're really still on the dance floor. When the time that we made this trade, you can see that our strikes are right around 200 and 199, and the market really hasn't kind of rolled over. And so now that we're getting closer to expiration, what we want to do is just extend that timeline, give the markets more time to possibly roll over a little bit further and give us an opportunity to make some money. So we don't want to be left here right kind of on the dance floor of making some money or not making some money at expiration. We want to give ourselves time, and so by doing that, we rolled out to October, so we roll out further, give ourselves a lot more duration in the trade, a lot more time to make money, and in this case, we got paid to do it, which is even a premium. All right, so the other trade adjustment that I want to go over is EWZ. So we had a very nice iron condor in EWZ, and EWZ made a huge move lower today, generally with the whole market. And we kind of anticipate a little bit of a move lower. We had set up our iron condor to be a little bit more bearish in nature, kind of tilted to the bearish side. But what we wanted to do is take advantage of the fact that there's still very high implied volatility in EWZ. So with EWZ, what we did was added an additional call spread above the market. So this is not necessarily an adjustment by rolling one of the sides down. And we're going to talk a lot more about this in tonight's group coaching call. We had an awesome group coaching call last night. This is going to be one of the ones that we talk about tonight. But what we're doing here is just adding an additional call spread to take in some premium and help kind of alleviate some of the stress in case EWZ does continue to move lower. So mechanically what we did was sell the 54.55 credit call spread, which is still above the market high. So we still have that working in our favor. And that additional credit just really adds to the underlying credit that we've received on the entire EWZ trade. So let's take a look at EWZ to begin with before we actually look at the profit loss diagram. And you can see that we've had a really, really tough couple of days in EWZ. And as a result, implied volatility has gone to even higher than where it was before. When we entered this trade, it was up around 57, 58. Now it's up around 78, somewhere around there. So it's actually gone higher, meaning that we could get a lot of premium for the options that we sell. In this case, we did the 54.55, which is still well above the market. So we've got almost about $4 or $5 of room that EWZ can run before it starts to affect this position. But what we were really concerned about was our strikes on the bottom side of this trade. So let me go to the chart here of EWZ. You can see that our original trade in EWZ, let me just take these off, the 54, 55. So our original trade in EWZ was the 58.59 call spread and the 48.49 put spread. You can see with the ETF now trading right above 50, that's kind of testing us to the bottom side. So it's moving much, much closer to this side. So what we want to do is we want to add that additional position right here at 54.55. And what that's going to do is that's going to help move out the break-even point on the bottom side because we've taken an additional credit that helps move out the break-even point over here, give us a little bit more room, and also helps move in this side of the trade because it's starting to work in our favor, so we need to readjust for where the market is. So now when I add that trade in, because I can just take it off and add it back in, now you can see that our break-even point has moved down to about 48.5, so it gives us a lot more room between us and the market, right? So it gives us a lot more room for EWZ to come lower before we start losing, and it's now capped our loss if it does continue to move lower at 235 versus originally our loss would have been about 350. So by adding in this trade and this adjustment, we cap our loss on the downside to 235. And you'll notice on the top side, we did sacrifice a little bit of that room. We kind of came in a little bit closer on the market, but that's okay. We took in a much bigger credit to be able to do that. So the game plan with this one is obviously just to leave it here for a little bit, probably next week or two. We don't anticipate making any more major adjustments in EWZ because we've got a pretty good profit window here. We can make about $265 on this trade. So I want to leave this one on here, see if we can't get some decay and some IV rank here in the next couple weeks. If it does continue to move lower, then what we'll do here, game plan moving forward, is just continue to adjust this 54.55 closer to the market. Again, taking in more credit, moving our break-evens wider, and recentering the strategy over the trade. So as always, I hope this really is helpful to you guys. Today was actually a pretty crazy day. We had a lot of different things going on, so always watch these video tutorials 2 or 3 times if you need to kind of catch everything that we've got going on. Have a lot of new people that joined up, which is awesome. I'm super excited for tonight's group coaching webinar. It's session 2 of the one that we did last night with about 20 people. This one is, again, sold out tonight for the same 20 or a different set of 20 people to talk about trade adjustments. So very excited to go over that tonight. But as always, if you guys have any comments or questions, just add them right below, and happy trading.